Good morning, everyone. Good afternoon, everyone. Good evening, everyone. This is session 9 of the MOOC, Financial Services and Cryptocurrency. I hope everyone is doing well and everyone is doing well with the coronavirus situation. As you can see, I am on day 9 of lockdown. So we are in lockdown chic. I even get to wear a baseball cap today. The Dimitri, if you'll see the chat, someone's mentioning that there might be some difficulty finding the videos. So I don't know if you want to take a look at that. I'll chit chat for a couple of minutes in case there's anything that needs to happen for people to join in. A little bit again on non-course items. We've been super busy this week, and I apologize. That also led to some of the delays on the course content, actually all of the delays on the course content this week, because we moved the whole university online this week, and we were taking online 300 plus courses a day every day this week. And I was looking at this session before I was going to upload it, and I realized I didn't believe half the things in my presentation, and so I decided to change them. And it ended up being, shorter, more conceptual. And so once we get through these specific questions, if I have time, I want to again go to some of the conceptual points, because I think those are the more interesting ones, as opposed to, is company X doing item Y today? So I think I'll get started. We have a question that's not exactly on topic, but I'll answer it in this early period since we already started COVID. What is the impact on this crisis on Bitcoin in the short term and also in the long term? I have a great answer to this question, and it's the same answer I've given to every crisis and Bitcoin price move up or down over the last 6 years. And the answer is 7 years. Who knows? Nobody knows. There are many theories, and people write many things, but no one actually knows anything. No one actually can consistently predict the direction of Bitcoin. If someone could consistently predict the direction of Bitcoin, just like if someone could consistently predict the direction of any other publicly tradable financial asset, you'd very quickly become a multi-billionaire, because you can easily make the correct bets, make lots of money, take that money, make the bet again, lever up, make the bet again, and pretty soon you're on the Forbes list of 400 richest people in the world, or whatever that list is. And so, since very few of the people that I see tweeting theories about Bitcoin on Twitter, I believe, have become multi-billionaires from their price calls, it's all a little bit. I don't have a dramatic point of view either way. Yeah, sure, Bitcoin was very volatile, but so what? Bitcoin's always been very volatile. Bitcoin will continue to be volatile for a while, and right now we're living in a strange world where normal assets are extremely volatile. Instead of Bitcoin trading more like a normal assets are trading more like Bitcoin these days. And the reason that is because there's uncertainty in the real world. And the reason Bitcoin tends to be volatile is there's significant uncertainty in the crypto world at all times. And so now that the real world has dramatic uncertainty about what's going to happen in a week or a month or in 2 months, you see that reflected in financial asset prices. So I would draw no particular conclusions other than the kind of self-evident conclusion that, unlike 7 years ago when most people thought it was a joke, Bitcoin is now important enough that people have a point of view on if it should have gone up or down in the middle of some global pandemic. So that's a form of progress. Beyond that, we will have to see. So let's go to this week's questions. See, given that I was so summary in the presentation, I made some sweeping statements, and they're right, but we can now unpack them a little bit. ICOs, STOs, IEOs at this moment don't work from investor protection perspective. I did write that. Then someone says, let's say it does get regulated one day. Can cryptocurrency still be considered as a different asset class? Bitcoin for now, for example, is seen as a different asset class, partially because of the decentralized nature where individuals get in first and companies only later. Same with ICOs, STOs, IEOs, but what if the playing field gets leveled by regulation? Okay, so let's take my statement and break it into parts. So what happened with ICOs in the ICO boom? Well, there were a lot of them, and they raised a lot of money. And through some combination of naivete of the issuer or naivete of the buyer, or actual, or the fact that early stage tech ideas tend to be high risk, or people who were doing this cynically as a scam, almost all the people that invested in these things did very poorly. Financial regulators don't like this as a general rule. They think this is poor form. And because the ICOs in general overdid it, the financial regulators in kind of most developed markets suddenly got much more interested in what people were doing and started paying a lot more attention to it. Now, what does paying attention to it mean? We'll discuss more of this next week in the regulatory section because it's one of the key areas of regulation, which is why I kept it brief in this section. But broadly speaking, emerging regulatory practice is that they're going to be treated, tokens will be treated in three ways: as payment tokens, securities tokens, or utility tokens. And there are going to be variations on this, but I think this is the most common underlying commonality across countries and approaches. Let's go to the two easy ones that end up later at the hard one. What's a utility token? A utility token is effectively a coupon. It's a gift certificate. If I ran Polemitis ice cream shop and I issued Polemitis ice cream shop token, and with that token you could do one and only one thing, which is buy $1 worth of ice cream from my ice cream shop. Those coins will have some value, maxed out at $1. It might be less than $1, it won't be much more than $1. What is that? It's a gift certificate. How is it going to be treated by regulators? Like a gift certificate. What does that mean regulatorily? Well, you can't trick people. You can't say, here, give me $1 for my gift certificate and then not honor it when it comes due and say, oh, ha ha ha, it's a trick. Did you see in condition number 17, you can't actually use this gift certificate. But other than that, it is regulatorily boring, let's say, not so exciting. So that's one category out. The second category is the interesting one, because the second category is effectively Bitcoin. Yeah, Ethereum has been shoehorned in there for practical reasons, but it basically is Bitcoin, and it's payment tokens. And what they're saying is something that is effectively something like a form of money that you use to transact. You're right, you can't treat it like a security in a private company that has tons of regulation about how you can transfer it, how you can use it, when you can use it, what disclosures you have to make when you use it, and so on. So this category was primarily formed for Bitcoin and maybe some others. And it tends to be strict to get into this category. We'll see how you get into this category by looking at the next categories, which is a securities token. Now, a securities token, kind of initial logic for this came from the United States, from something called the Howey test, that was a test of the Supreme Court decades ago, that said if a security is not what you call it, is what it is. If it looks like a duck and walks like a duck and quacks like a duck, it's a duck, even if you say it's a hamburger. So the law in the United States is not something is a security if you say I'm issuing a stock or I'm issuing convertible debt. Something is a security in the United States if it meets the tests for something to be a security. And those tests have nothing to do with what you call it. You could call it a token, you could call it an ICO, an STO, an IEO, a Polemitis EO, irrelevant. Your label doesn't matter. And the test is they're a common enterprise that people believe they are going to get a financial return from. And we could teach you a whole course on the Howey test, but basically, if you look centralized and you're issuing something that looks like is going to have price appreciation based on the work of your centralized team, most regulators are going to say, look, you issued a security. You have to abide by the rules of issuing a security. You don't get a free hall pass just because you called it a token offering. It's annoying to say what I'm about to say, but I think that's probably what you have to do, because otherwise every single rule on securities offerings will just get end run by someone saying, oh, right, well, I'm doing it on a blockchain, it's not a security anymore, none of your silly rules apply to me. And there's no way the regulators are going to take that type of stance. There is a reason there is securities legislation. It has to do broadly with investor protection. You can argue that the legislation is too strict, that it's not strict enough, that it's not really well suited for small private companies, that it's not suited, that it's overly restricted to accredited investors. You can argue all of these things. But it's hard to argue that whatever the policy is for time to time only applies if you don't call it a token. And if you call it a token, then it doesn't apply. Because that's a huge loophole in the existing securities legislation. And this might have gone a little differently if the ICO boom didn't get so out of control and people did not get so scammy. I mean, that's the right word. But to the degree that there was any chance of convincing the regulators that, no, this is different, we're not going to act like, and I don't mean we, anyone in this class, right? I mean that people are not going to take advantage of this and act like scammy, small stock, bucket shop, boiler room promoters. Well, that chance was lost after many people did this. And so a logical thing for a regulator to think and conclude about the ICO boom is, oh, you see, there's nothing new under the sun. The second people think they can do unregulated securities offerings, the immediate thing they go do is try and scam their local dentist out of $20,000, right? Just like you would see on, I don't know, Wolf of Wall Street. And I don't know, they're not wrong. The regulator's not wrong, right? Like, that's exactly what happened. So, of course, there are some super interesting technical innovations in fundraising. The idea that you can fundraise directly from individuals in small amounts all around the world overnight was beautiful and amazing and really a joy to see. But the framework and the practice, I think, were wrong. And so now, could you do an actual decentralized offering today, like Bitcoin, and get something out as a payment token today and not get it under securities legislation? Yeah, I think so. But then you have to do a bunch of things that the type of person thinking of doing an ICO doesn't want to do. Right? You can't run it for your own benefit. Right? And so if you're running it for your own benefit, the way you'd be issuing stock in your own company for your own company's benefit, you'll end up being classified as a securities token. So what I think will happen here is it will be a real innovation. It will be an area where people will issue a variety of tokens, payment, utility, securities on blockchains. It will be a very big step forward, but we are in a hiatus right now, a slumber, while the regulatory regime clarifies. And then when that clarifies, people come up with a new set of ideas that fall somewhere within the regulatory regime and are also appealing both for the project and for the people contributing money to the project. So, I mean, this is very of now. I'm on the Cyprus committee for figuring out the separate regulatory approach to these offerings. And these are the issues everyone's thinking through, because these are the, in fact, right issues. So I don't think it'll be this. So the question is, does the playing field get leveled? Well, sure, the playing field gets leveled from the perspective that if something would be an out-and-out scam if you did it and called it a stock, it really should be called a scam even if you call it a token. Will there be innovation in being able to do types of offerings and pull together types of investor or community or contributor bases that are different than you would in traditional securities offerings? Yeah, I think so. I think that there's going to be a difference, but it's just not going to be as much as a free-for-all as people maybe thought it would be. Next question. Crypto assets and financial institutions. As more and more interests are taken up by the financial institutions and they are having an influencing effect on the crypto ecosystem, do you think they'll end up defining the rules and regulations for all the segments of the crypto world, despite the fact that there is some self-regulation in the crypto ecosystem already? I would argue that there's not that much self-regulation in the crypto ecosystem right now, A. B, whether the crypto ecosystem wants to or not, or whether financial institutions want to or not, most regulators have taken the position that many relevant types of businesses are regulatable, subject to regulatory supervision. I think that's to be expected. I think it's inevitable that there are going to be companies formed in the space, and I think it's inevitable that those companies will be subject to regulations appropriate for the type of company that they are. Particularly once you're a company. It's pretty hard to take the position that you shouldn't be subject to the rules of other companies of that type. Right? Like you can get yourself there sort of that, look, I am this distributed, decentralized blockchain. Nobody's in charge. Nobody can be in charge. We're all equal participants. So who are you going to regulate? That kind of makes sense, right? Like, let's say you wanted to regulate Bitcoin, the cryptocurrency blockchain itself. Who? Who is the SEC going to send a letter to? There is no CEO of Bitcoin, right? There is no general counsel of Bitcoin. There is no SVP of regulatory affairs of Bitcoin. There's no one that you can actually send a letter to. But if you are Coinbase and you're running an exchange and you're a company and you have a CEO and a CFO and a general counsel and you take people's money and you convert it to Bitcoins, or you take their Bitcoins and convert it to US dollars, and you hold on to both of them. Okay. Why should the regulation be any different than if it was Coinbase, the exact same Coinbase, and they were trading, I don't know, barrels of oil? There's a fiat to oil exchange. It's a company, there's a CEO, you put money in, you buy barrels of oil, you sell barrels of oil, you get money out. Well, I mean, that seems like logically you're going to get regulated in some type of similar manner to that. Next question. Slide states, most consumers and merchants do not want to directly interact with the protocol, but instead through an intermediary. The same model is developing in cryptocurrency. And the question is, great observation, thank you. But isn't that due to the unfamiliarity with the protocols? If a protocol can be as understandable as a vending machine, quote, money in, a chosen product out, all automated, end quote, and a protocol is regularly audited, wouldn't over time those same intermediaries not be needed, except for the protocol auditors? I think yes and no on this. So I'll tell you the yes part because that's easy, and we'll go to the no part that is harder. The yes part. For sure, as the protocols get easier to use, as the tools to use the protocols get easier to use, more people will use the protocols directly. I think that is an accurate statement. So since we're quite early, the protocols are technical, the tools are technical, they're not really consumer ready, right? Like big consumer businesses, like, I don't know, Instagram. Instagram is pretty easy to use. You don't need any advanced skills. You download an app, you take a picture of the pictures you follow. Things of that nature are things that scale to billions of consumers, right? Like that, Netflix, Google, TV, radio. All of these things are vastly simpler than have a Bitcoin wallet and do a transaction. Like, I have a computer science background, and I find it took me some time to figure out what Bitcoin was, how to use it, and I'm still semi-terrified that I'll mess something up and send $1,000 not to like Consensus to buy my ticket, but to some other place, and then I'll never get it back. Right? Like, I mean, it's so. Of course, they're not in any way consumer friendly now. Of course, if they get more consumer friendly, more consumers will use them directly. But I still think the nature of what a public cryptocurrency blockchain is means that it's going to be hard to totally eliminate intermediaries. Let's start with the very simple case. Should you store your Bitcoins on your own wallet, or should you store your Bitcoins with a third party? You have heard earlier in this course from Andreas Antonis. Andreas believes you should store them on your own wallet. I believe his current advice is, for most consumers, a hardware wallet's a good choice. Used to be earlier a paper wallet before the hardware wallets got better. I think that is reasonable advice for a subset of people. When I think about the 1,000 people I know, that I know well enough to have an opinion about their tech skills, the percentage of them, I don't know what to guess what the percentage is, but the percentage of them that I would, if they came and said, look, I've bought 5 Bitcoins, I said, wow, okay, great. How many of them I would feel comfortable saying, you're going to manage the whole process yourself and keep them safe yourself and not mess something up yourself, and don't lose your treasure or your password or yourself? Well, certainly not 100%. I mean, not 0% either, but somewhere between those two. And this is the simple case. This is the day one, class one case of cryptocurrency, right? Like, have a Bitcoin wallet. This is as easy and straightforward as it gets. Like, everything else builds on that. And I don't know. I don't know that it's a great consumer like, most people, I mean, okay, there are some hardcore people that have huge Bitcoin holdings, and yes, they have invested a huge amount of time and energy in keeping them safe themselves, and that's fine. But let's say you're not that. Let's say you're a regular person. You are not tech savvy. You have a normal job. You're a director of graphic design at some company. And you have your life savings. Is it really logical to say your life savings should be in something that if you lose the password, and I'm simplifying, but broadly speaking, you lose the password, your life savings are gone? And so you like start working at 20, you're gonna retire at 70, you'll probably live another 20 years. So for like 70 years, you have to keep it safe and make no mistakes. I don't know, that doesn't seem totally right, to be honest. Right? Like, I mean, if you did that, you'd have a constant series of tragedy stories. Bob Smith worked his whole life, just retired, did one mistake, and now he is bankrupt. And of course, there's no recourse. Where's he going to go? To the CEO of Bitcoin? No, it's gone. His Bitcoins are gone. So I think there will be a role for intermediaries. I don't even think that it's a bad thing. I don't think the like everything else in life, things are a gray zone. So a very popular saying in the Bitcoin community is, not your keys, not your coin. True. The only way you for sure own those Bitcoins are having your keys. But that's not an absolute, right? You're just trading one type of risk for a different type of risk. What are the three risks that you're trading? There are risk one, you lose your coins, right? Someone steals them, someone does a SIM attack on your phone, someone whatever, right? Like someone gets into your computer, someone gets into your safe, you lose your safe, your dog eats your treasure, whatever. There are literally hundreds of examples I've seen over the last 7 years I've been involved in this, of people losing their keys. Like it happens. So, not your keys, not your coins, but if you lose your keys, also not your coins. So that's one risk. The other risk, counterparty risk. So this is interesting, right? So counterparty risk means the following. You have coins sitting on Coinbase. Do you have coins, or are you a creditor of Coinbase? I believe you're a creditor of Coinbase. I think. And that's not legal advice. You have to check the jurisdiction that you're in. Blah, 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 blah. But you're a creditor of Coinbase. By the way, you have money at JP Morgan Chase. Do you have US dollars, or are you a creditor of Coinbase, of JP Morgan Chase? You do not own US dollars. Your bank account also has this characteristic. You are a lender to JP Morgan Chase. Specifically in the United States, you are a lender that has a government guarantee for the first 100,000. But after that, you don't. You're taking on credit risk. You are taking on the risk that JP Morgan is not able to meet its obligations, and then whether you get paid or not has to do with a variety of factors, including where you stand in the priority of creditors, do they get a government bailout, and blah, 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 blah. So, not your dollar bills, not your cash, not your dollars, also true. Does that mean if you have $200,000 of cash in a business operating account, you should put it in a safe under your desk? No, I don't think so, right? Like, because is the risk of JP Morgan collapsing zero? No. Is the risk of someone holding me up at gunpoint because I have $200,000 in cash under my desk zero? No. Right? So, I mean, there's no solution that's risk-free. Now, there's the third bucket. The third bucket is seizure risk. Just like the U.S. banned private ownership of gold in 1934, right? 34. And someone says, whoa, these Bitcoins are really going valuable. We are heading into hyper-Bitcoinization. We don't want this, or fiat currencies are collapsing. Let's seize all the Bitcoins. Well, that is for sure a case, not your coins, not your keys, not your Bitcoins. So, and this is a complicated one. So there you will lose them, right? Like for sure. And if you don't have them, if you have them on your Trezor, you'll have them. I wonder if a world there. Here we're getting into like game theory that no one knows the answer to, right? But like, I wonder that if in a world where holding Bitcoin is illegal and all the Bitcoins have been seized at the intermediaries, if the Bitcoin you have on your Trezor does in fact continue its hyper-Bitcoinization ramp up. I'm not so sure about that, right? Like, because in the mode that the government's that aggressive, people might be afraid to accept your Bitcoin. So, but that's the third risk. Now, there's also another variation of this. I mentioned Coinbase, and I mentioned them for a reason, because there's Coinbase, the exchange, where I think you're a creditor, but then there's also Coinbase, the New York State licensed custodian. In the custodian, legally, they are segregated. They are bankruptcy remote. They are, in fact, your Bitcoins. So if you have Bitcoins at Coinbase Custody, if Coinbase Custody Trust Limited, Incorporated, whatever the company name is, goes bankrupt because it can fail to meet its obligations, your Bitcoins don't get dragged into bankruptcy court. They're still your Bitcoins. It doesn't help you against the seizure risk, right? If Bitcoins get illegal and the government may become illegal and the government seizes all Bitcoins, the custody ones are still gone, but you are protected from credit risk. They charge you for this, of course. There's a paid service. When you just park them on the exchange, they don't charge you to keep the Bitcoins there, because they're making money off trading fees. The running a whole custodian with meeting the regulatory requirements of the custodian and security and what have you costs money. And if you're just holding them there in cold storage, you're not generating trading fees. So they're going to charge you something, because it makes sense. Otherwise, how do they have a business? So I believe intermediaries will exist for these reasons. I do not think holding things directly on the blockchain is the right answer for everyone. I would not feel, I saw a comment in the chat, and I'll address this directly. I would not feel intimidated by not your keys, not your coins. It doesn't mean to not take that seriously. It doesn't mean that you might not want to learn how to hold some of your crypto directly and test that, but don't feel badly. I mean, some of the biggest crypto hedge funds in the world are holding their own coins with custodians. So it's gray zone. It's just like the rest of your life. If you want to have no counterparty risk on your cash, put it under your bed. If you want to have limited seizure risk of your cash, put it under your bed. If you want to have no risk that a thief can come into your house and take your cash, don't put it under your bed. Right? So these are in fact the trade-offs. And because these trade-offs exist, and these trade-offs are real, people will do all of these variations that I just mentioned. And since they'll do all of these variations, there will be intermediaries. And since there will be intermediaries, there will be financial institutions engaged in activities in the cryptocurrency space. This is a great one. Great one. Is slide 7 made by a banker? This is awesome. I want to say I have never been a banker, though I have worked in the traditional financial sector. There isn't that much trust in financial institutions, in my humble opinion. But before Bitcoin, cryptocurrencies, and blockchain, there was just no alternative. I wouldn't call it a friendly consumer environment with the argument taxpayer protection for deposits under $100,000. 100% of deposits should be owned by the depositor, even in a bankruptcy of the bank. Every other statement is naive. This is awesome. This is awesome in every way. It's a great question. It's a question that comes up a lot. And so I'm glad someone asked it. I totally disagree with the premise of this question, by the way. The reality is that over the last several decades, the likelihood that you would lose your money in a bank as a depositor in a bank resolution in a developed country is very, very low. The shining example of the opposite was the Cyprus haircut in 2013, And it became part of the reason it was such a crazy example is that it was so rare, and that never happened, and it was more or less imposed on Cyprus by bigger countries in the EU for a variety of reasons that we won't get into today. But it is, I believe it has not been a substantial risk of losing your money when you put it in a bank account and in effect lend it to a bank. I do not think for the average consumer, the risk that you will lose your money depositing it at JP Morgan Chase is higher than you lose your money putting it on a Trezor. I think the average consumer is at least as likely to lose it on a Trezor, if not more likely. I understand, in theory, the risk is lower if you keep it yourself. But that's sort of like in theory, like if we all went to the gym and ate properly and lifted weights and did jogging and swimming every day, we could all have, on average, a 10-year greater lifespan. In theory. The people that do that will have a 10-year greater lifespan. But you can look around, and of course, not most people don't do that, myself included. Also, what you also get with Bitcoin is immense price volatility. Immense. You might like that from an investment perspective. That's fine. It's not really the most practical coin to keep your checking account in, right? Like, I would never run my day-to-day checking account in Bitcoin, right? I would never ask for, I have to meet a variety of monthly obligations. It would be stressful if every month I don't know if my paycheck would cover them times 2, cover them times 0.5, right? Like, that's, I don't think a normal person can live like that. Bitcoin is an investment product in effect as it is now, not a unit of account type product, right? So now how could you have 100% of your deposits owned by the depositor, as the gentleman asked here? Well, you can do other things, right? Like, you could buy treasuries, and then you would have, you don't 100%. You're backed. It's the least likely instrument to default in the United States, right? Like, the Treasury should be able to generate dollars to pay off its obligations. You'll have a little bit of price volatility, more so than a demand deposit, but if it's a short-term Treasury, not much. There's an interesting idea that has been floated about letting consumers and businesses have direct central bank accounts. That's a super interesting idea. It's the idea that says you can go make a deposit directly at the central bank. You take on effectively no counterparty risk in that case. And I believe if you reran the world starting from today, many countries would do that. I think they're afraid to see what the implications will be on the commercial banks. But it's an interesting idea. It's a potential idea. And it's a potential idea that doesn't require cryptocurrency. Right? You could do that without cryptocurrency. So, there's nothing in life that's risk-free. It's useful for consumers to know that lending money to Bank of America is not risk-free. It's low risk, but not risk-free. It's useful. I'm in favor of people understanding that. But it's also equally useful that people holding cryptocurrency are open-minded and clear-eyed about the risks that they're taking. So So long as people understand that, then whatever choice they make is fine. But I don't think the answer is black and white. And I think you can see at any point in time what people believe in aggregate by their behavior in aggregate. In aggregate, people feel pretty comfortable leaving or depositing a lot of money in banks. There's not an option. They know about better things. If they knew about Bitcoin, they put in Bitcoin. Not so sure. I mean, I'm sure there's too many people now that haven't heard of Bitcoin at all, right? Like a lot of people have heard of Bitcoin at all. A number of people that are saying, cool, I'm closing down my checking account because I don't trust the FDIC protection limits and I'm going to put it in Bitcoin. I don't think people think that, because you'll take on a variety of other risks, including volatility. They say, oh, I'm going to do a stable coin. Boy, I would be, again, the stable coins tend to have their own weird mechanisms for supposedly maintaining stability. And I believe I'm still more comfortable with JP Morgan than with any of the stable coins as I've seen them so far. This is my consensus, but it's a very good question. It's a question that comes all the time, and so I'm glad someone asked it. Someone asked, does anyone know which insurance companies provides coverage for insurance for crypto exchange, and which custodian to use for crypto exchange? These are the requirements for getting a license for a crypto exchange in Hong Kong. Oh, well, this is a very hardcore operational question from someone who is, I guess, thinking of setting up a crypto exchange. I know I keep hearing this about the PC, but I have the sound off on my PC, so I don't know where the notifications are coming from. Let's see if this makes them go away. I think the best one, there are some insurance companies now that are providing some insurance for companies that hold other people's cryptos. Some. It has changed over time who they are. It has changed over time how much they are able to cover. And I think the best way to discover who is in the market to do these things is to go through all the big existing crypto companies and any ones that say that they're offering some insurance, get into their terms and conditions, and read who the insurance is coming from, because it's usually somewhere in there. And so I'd give you a couple of warnings on this. I don't think it's easy for a startup crypto exchange to get insurance. I think the ones that have it now were ones that got to a decent size and track record, and then the insurance companies had confidence to insure them, or were backed by big backers, and so that, again, the insurance companies had confidence. The number of, I think, a pure startup crypto exchange in startup mode will have trouble finding insurance. Next question, custodians for crypto exchange. I'm not going to be recommending specific firms here on the course, but I think there are not a lot of custodians today for crypto. I can think off my head of a couple, and maybe there's 5, 7, I don't know, that are actually licensed custodians, if there are that many. My suggestion is you Google around and you'll figure out pretty quickly who the active custodians are. And then good luck. If you're setting up a crypto exchange, that's a big task, an important and a tough challenge. Okay, now, Dimitris has pinged me with a couple of additional questions. I have a call in 6 minutes that I must be on, and so I can maybe do one or two of these, maybe. Okay, this one was in there. I can do this one. What did I change my mind on? When I originally wrote the deck the first time, there was a lot of material on how payments would evolve with crypto and what would be the necessary conditions for kind of end-to-end payment infrastructure. And what would that need to be? You need mature exchanges and mature wallets and mature merchant processors and high consumer adoption. And the more of this you had, you get into a positive cycle because you have more liquidity in the system. Spreads go down. You might eventually believe that volatility goes down, but even if it doesn't, spreads go down. And therefore, you get a kind of robust payments infrastructure with digital currency. Well, it hasn't happened, right? So, whatever I think or don't think, I like to stay grounded in reality, and in reality, that actually hasn't happened. And I think it's challenging right now for a couple of reasons. It is the combination of the price volatility and the current US tax policy, and similar in other parts of the world, that every time you buy or sell a coin, it's a taxable event. And so that's just a huge nuisance and kind of a nightmare if you want to be compliant and also use cryptocurrency for payments. And so I don't see, while this current approach is in place, how you can have mass adoption of a private cryptocurrency that trades against a sovereign currency and whose exchange rate is moving every second. How you could have mass adoption for payments. Was that the notification that you guys are hearing? That buzz that just came now. How that actually could happen and not create a tax reporting nightmare for many, many people. So I think that is stalled right now. It might come back with CBDCs, right? Because CBDCs, central bank digital currencies, if you have a digital dollar, could you see a digital dollar being used for digital payments? Yeah. Will it have tax effects? No. Why? Because you won't have gains or losses. It'll be linked to a normal dollar. So that was a big part of the prior deck, and I looked at it on Sunday, and I decided I didn't believe it anymore, and so I took it out. And then I decided I didn't believe some other things, and then I took them out. And by the time I was done, there was nothing left, and I started over. And so there were like 60 pages of things from the fall, and by the time I was done, I decided I didn't like any of them. Okay, I have 2 minutes before my other call, so I'm going to have to drop off. Thank you all again for joining. Come back next week for regulation. I know it sounds boring. It's super, super, super interesting because it's the way to realize what cryptocurrency is or isn't and what a weird, interesting creature cryptocurrency is. Because you see that most when you see how it matches or doesn't match with existing regulation. So I hope to see you guys next week. Stay safe, and we will be back in touch. Thanks, everyone.